Hey, it's Tim and Lisa, and you're listening to the REI Concierge podcast. The REI Concierge helps Americans living abroad find and buy great investment properties in the U.S. From analyzing markets to finding local partners to closing your first deal, we are partnered with you every step of the way. Let's jump into today's episode. Hello, and welcome back to the next episode of the REI Concierge podcast with Tim and Lisa. Tim, how's it going today?
It's going well, Lisa. It's just you and me today. And, we're counting down the days until Robinson number 4 comes along. So it's just kind of a holding pattern here in Maryland. Just waiting for that little baby to come out. So in the meantime, we're just going to keep talking about the housing market and, teaching people what we think is going to happen, even though no one really knows.
I am enjoying the thinking about the fact that we are recording this on October 13th, and perhaps by the time it is released to the world, Robinson number 4 might be here.
It could be the birthday.
Maybe I'll be prophetic.
Yeah, it could be. You never know. It's literally any time now. So, hopefully not during the podcast, but maybe after.
Well, if you need to leave, by all means, please.
Luckily, this isn't actually live, so we can stop and record this later. But yeah, I'll let you know if I got to go real quick.
Yeah. So, as Tim mentioned, it's just us talking today, and we thought we would bring you some unofficial notes on the housing market. And I want to emphasize these are unofficial notes. We are not economists. We are not financial advisors. We are not attorneys. We are not prophets.
We are definitely not prophets. We just read about real estate and have our own thoughts, and wanted to talk to you, dear listeners, about some of our thoughts. And, let's hash it out a little bit. But yeah, don't fact check us because, we get our facts from other people. So fact check them. That's what I'm trying to say.
Speaking of other people, I recently listened to a podcast by David Stein of Money for the Rest of Us and said, Tim, you got to listen to this. And I think we should talk about this on our podcast. And I really like David Stein. He is a financial advisor, and he was just talking about the housing market and looking at it and kind of asking the question, should we expect a crash coming up? And he's looking at it from some really interesting angles. And I mean, should I do a spoiler alert here that things are not pointing to a huge market correction or crash, like we like to talk. We like what are the kind of words like crash and horrific and
so many exclamation points. Yeah. All the exclamation points, all the hyperbole. I think everything is going to be just fine in the grand scheme of things. And again, no crystal ball, no prophecy here. But I mean, we all know how media kind of hypes things up, and there's a small indication that housing prices are ticking up, and the mortgage forbearance is over, and everything's coming crashing down because it happened once in 2008. So I think a lot of people are expecting it to be kind of the same thing as it was in 2008 when the bottom just fell out of the market, and people were losing their homes left and right, and it was a terrible time, and real estate investors kind of came in and swooped them up for pennies on the dollar. None of the signs are pointing to anything like that going to happen. It's just a different framework than it was in 2008. And the fact of the matter is, a lot of people, like you said, Lisa, they have equity in their home. So even when this mortgage forbearance, comes to an end, it's not like, everyone's just going to get evicted. People have equity in their homes because during this mortgage forbearance across the country, home prices have skyrocketed. So even if they didn't necessarily have equity before the mortgage forbearance program went into place, they almost certainly do now. So it's not going to be a matter of, oh my God, I'm losing my house. I have to, downsize, downgrade. And I don't know what I'm going to do. They can most likely sell their house for more than they paid for it and find a different solution. So I think it's interesting to see how all these pieces play together. And it's a very weird time for all the reasons. But at the same time, when you see headlines like, is a market crash coming? Is this a bubble? Blah, 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 blah. Like, I think the short answer is no. It's just a matter of I guess, examining the fundamentals and, what all the indices are pointing towards, and kind of seeing, I mean, again, we're not going to prognosticate, but basically we just see things being just fine, I guess. I don't know how to say it more plainly than that. There's going to be some things that happen, but I don't think it's going to be any kind of crash or bubble or anything like that.
Well, and I think it's worth unpacking, since you like that term so much.
Ugh, the unpacking.
I'm going to say that more and more just to aggravate,
I know you are.
You're welcome. The mortgage forbearance program that is coming to an end, I want to acknowledge for myself that back in 2008, 2009, I was incredibly fortunate to not actually be paying that much attention to what was going on. And that could talk to my fortunate situation in life where I had a job and a house and nothing was disrupted. And also just my ignorance, perhaps, and blinders on and just living my life and not paying attention to all these things. And one of the comparisons that I found really interesting now is, I mean, the numbers are, back a year ago, I think there was about 7.2 million people that were participating in the loan forbearance program who were not able to keep up with their mortgages. Now it's down to 1.7 million. And the majority of those people, they're not underwater. So their house is worth more than they owe. And that was just not the case. So back in 2008 or so, if you had bought your house for $600,000 and your mortgage was $425,000, all of a sudden your house was worth $350,000. And that's what forced people into foreclosure, because selling, they would have still owed, $125,000 to the bank. And so it just wasn't possible. Selling wasn't an option then. So foreclosure was really the only option. And it's different now. So if I couldn't pay my mortgage after this forbearance program ends, I could just sell my house, pay off the mortgage, probably still have a little extra cash in pocket, and go on with my life. And that's one of the really significant differences for people who are kind of anticipating lots of foreclosures coming up. There still may be some. And if people have to start selling their house, it will increase the supply of houses on the market. So I think those are interesting comparisons.
Yeah, totally. No, those are all great points. And I think I read somewhere that the number of people, like you said, in mortgage forbearance program, you said it's 1.5 million or something like that now, down from a high of over 7 when it was at the height of the pandemic. And I read a prediction that Zillow's not just that little website where you go in and type things and do your little SNL browsing late at night and dream of the house to become. Zillow's a monster. They buy up houses, and they're a big player in the real estate market, and they are predicting that only 25% of those folks that are currently in the mortgage forbearance program are going to probably lose their houses because of inability to pay. So I can't do the math, but what is that, like 300,000 people, which is terrible and unfortunate and hopefully doesn't come to fruition. But if that is the case, it's not going to be, 10 million people. We're talking maybe 300,000 people will be forced to sell. And even like you said, that's just obviously just a prediction. And worst comes to worst, they hopefully won't be too terribly underwater if they are foreclosed. Like, they'll be able to get some equity out of there and start fresh somewhere else. But and obviously anyone losing their house is a tragedy. But when we're talking on the grand scheme of things, like 300,000 people out of 380 million Americans is not. It's unfortunate, but it's not crazy. It's by no means a crash or a bubble or anything like that, is what I'm trying to get at. And on the other side of that, we're still in a massive housing shortage in this country. I think Fannie and Freddie predicted that we are 4 million housing units short going into 2022.
3.8
and builders
million.
have just started. It's nuts how many houses we need for the number of people that we have. And I think building is just starting to ramp back up because of, lumber prices have been skyrocketing and just no supply of basic building materials. I mean, that's starting to help with some, sawmills being built here in the US, and the reproduction of lumber and stuff like that is starting to ramp back up. So it's becoming a little bit more affordable to build, but like, you can't just build all these houses overnight. So there's still a massive housing shortage as well. So there's so many different levers that are being pulled on from so many different directions in the economy that are just totally different than they were in 2008. And I didn't really want this podcast to be a comparison of now in 2008, but maybe that's actually a good way to go, because I think there's so much fear associated with 2008 that we kind of want to dispel that and just say, don't worry. I mean, it's a crazy time in the world for everybody, but this is not 2008. And I think there's so many different things in play that just didn't exist in 2008. So maybe we do keep going along that strand. What do you think? We just keep it loose here. We just go as we go.
That's what we always do, Tim.
It's great.
I think one of the things that is important to keep in mind, and we've been saying this for almost 2 years now, this has never happened before. We've never seen this before. And so is it wise to be cautious right now? As a more risk-averse person, I'm saying yes, right? John and I sat down a couple of weeks ago, looked at our whole financial portfolio, and made some decisions not to be super aggressive over the next 6 months.
Yeah.
Like we're gonna continue on this path. We're not pulling back and doing anything, crazy. And we're just like, well, let's just be cautious. We're great where we are, and we don't need to aggressively grow our portfolio right now. So we're kind of saying, well, like, let's just maintain the speed we're going.
Sure.
And kind of see. And I think it's going to be different for everyone. I'm not saying everybody else should do that. I'm just saying that's how we're looking at things. And for those who are feeling uncertain about the market, about the unknowns, hey, like it's okay just to say, hey, let's just ride it out a little bit and let's see what's happening. And it's a great time to maybe save up some more capital towards your next down payment, depending on your greater financial plan. If you're paying down the debt on one of your houses, then you could put the extra money towards that. We talked a few weeks ago about the debt snowball with Chad Carson. Lots of different things that you can do that I know it feels for some people, and I've experienced this too, where any sort of slowing down can feel like, oh no, I'm not doing anything. And it's not necessarily feasible to be buying a new property every 3 months. And when we do kind of slow down on the acquiring additional properties, it might feel a little bit like, oh no, am I missing out? Am I, being too conservative, whatever? And not necessarily.
Yeah, no, I think those are great points. And I think that FOMO, that fear of missing out, is honestly one of the biggest contributors to why housing prices have gone bat-ass crazy over the past year. You know what I mean? Like everyone's like, oh my God, there's no houses. There's going to be, this impending doom and crash and burn. And I just got to buy all these houses and waive all my contingencies and pay all cash. And, again, these are just my opinions, but, get myself in debt, buy more than I can afford because I'm not going to be able to get a house. And all that is just, it's manufactured. It's not true. But unfortunately that happens so much and so fast across the country that it just, artificially inflated the prices of houses nationwide. And now we're starting to see them come back to reality. That's all this is, as the prices on homes have ticked down over the past 2-3 months and probably more into the fall. We just wrote a blog on how it's probably going to continue to drop. And keep in mind, with a grain of salt, this is not drop below what it used to be. This is drop back down to reality. That's all it is. I mean, they've been artificially inflated because of this panic buying that we've seen. I don't want to say rightfully so, but understandably so. because everyone's been scared with COVID and they want to get out of the cities, and they want to get the single family homes with the yards and stuff like that. So all these factors have led to just skyrocketing prices. 24% over the past year. It's just nuts, some of these numbers that a lot of markets have seen. But now we're starting to see that come back down to not where it was pre-COVID, which is good for us real estate investors that already own properties. But at the same time, it's leveling out. And that, as soon as any housing prices dip, some people want to say there's a crash coming. But I think it's just, the natural order of things. It's kind of like a seesaw, and it's coming back down to where it was supposed to be balanced.
Or even if it just stabilizes, when there's such a steep increase in prices in such a short time, just the stabilizing of the prices can feel psychologically like a drop. And it's not, it's just a stabilization.
Right. Exactly.
And I think there's a couple of points, and I will attribute my knowledge and numbers of this to David Stein again, but I like what he called the demand shock that happened in 2020 to 2021. And there were more people that were willing to buy all of a sudden. We have an estimated 2 million new households being formed in the US every year, only 1.5 million new homes built. So there is this shortage. Interest rates came down. People were saving more because they weren't able to travel and have experiences and be going out and doing all the life things that they normally did. So they had money in their pocket. And interesting that cash supply increased by 20% over the last year. So that just tells us how much people weren't able to spend in normal. People were forced to stay home. So what you mentioned about people wanting to move out of the cities before COVID, so many families spent very little time at home. I mean, you wake up in the morning, you get the kids off to school, you go off to work. After work, you're going here, there, and wherever with the kids. You get home late, grab some dinner, go to sleep. And now all of a sudden people are in their, living in their homes. And
doing nothing but being at home. Yeah.
We need more space.
I need more space.
I don't like my house. Now I have to work from home, and the kids have to go to school. So we need an office, and we need a classroom, and we need more room. And there was that as people started moving and the housing supply decreased. You've mentioned it already, but that FOMO, fear of missing out, and all of that combined really led into this demand shock, which pushed prices up. And on one hand, great for homeowners, challenging for those wanting to buy. But it's just an interesting, when you kind of look at that, it's like, okay, well, it all makes sense. That's kind of how the economy works.
Yeah. Yeah, no, I think it is fun. It's one weird giant jigsaw puzzle. Everything, it's funny now to look back with hindsight over the past 18 months when this thing first started happening, when everyone's like, oh my God. I remember, all right, real world example, we like stories here. I remember calling when we were still in the Netherlands, and I was looking to potentially, and still will eventually, 1031 one of my houses in DC into some multifamilies in the Midwest. And I hadn't looked at so Lisa and I both do we track our net worth very diligently, because that's a big part of how we invest. And it was probably 3 weeks into the month. So I hadn't checked my net worth for those 3 weeks. And then I talked to a lender to just kind of get some advice and some quotes and some figures about a rate on some houses in the Midwest, as well as 1031ing a house in DC. And I think one of my houses in DC had gone up like 40 grand since the beginning of the month. Cool. I mean, just insane. Yeah, cool, right? But at the same time, if you're not paying attention even for 3 weeks during the height of this thing, I was like, that doesn't make sense, and that's not right. Bottom line, this is not worth $40,000 more than it was 3 weeks ago. Something's wrong. And that was kind of right. It happened to be right at the beginning of this skyrocketing exponential growth on the values of these houses across the states.
Something's right with that, Tim, not something's wrong.
Right.
Something's right.
I mean, it is like for us as real estate investors, we're like, this is fantastic, but we also know this is not real, like this can't be
Not
sustainable.
sustainable.
It's just not. And, and people that don't look at real estate all the time see these things and they're like, I'm never going to be able to get a house unless I do it right this very second, because tomorrow it's going to be $50,000 more, And I think that kind of like just almost mass hysteria was like, all right, we all need to go get these bigger houses or we're never going to have an opportunity again. And now people realize that's simply not the case. You will, things will start to normalize. Housing production will pick up. We are still at a shortage. I mean, there's no way around that for all the factors that we've seen in this jigsaw of, economic policies and, shock that has come from COVID. But things will get better. There will be houses built. There won't be this much of a shortage. There are smart people in positions of power that are making these policies that are going to help us get through this. And it's interesting to see this kind of like, oh God, I gotta get a house. Okay, I can breathe again. And it's just kind of like the whole economy swelled and kind of like exhaled over the past 6-7 months. And it's actually good to see, even as a real estate investor that's potentially losing value in his houses. They're not really losing value. They're just going back to how they're supposed to be. So I don't know. It's just funny to see from like a high level why we do these things and the outcomes that they have. I don't know.
And I think for you and I, we are largely focused on buy and hold real estate. So we buy for cash flow. And if the price is correct, if the value of our homes drop by 20%, as long as the rent is still being paid, it's okay that the value dropped by 20%. I hope it doesn't drop by 20%, but if it did, it would be okay as long as people are renting the house and paying the rent.
Right.
And over time, that value will come back up because that's part of the market cycles. And if someone is listening and has concern, an interesting exercise would be to look at your real estate portfolio, look at the current worth of all of your properties, and then see what would happen if there was a drop of 10% of the value. Well, what would that look like? Well, I mean, if you want to think worst case scenario, what would 20% look like, right? And again, as long as you have tenants in the property, which interestingly enough, vacancy rate right now is at 6.5%. And just as a comparison, 2009, it was at 11%. So much higher back in 2009. People are renting. Rental rates are continuing to increase 2.4% this last year. And so again, there's a lot saying we're not going towards this huge crash. A crash would need, and I'm quoting David Stein. If I quote him enough, maybe he'll come on our podcast. I really would love to have him as a guest.
I see what you're doing here. You're angling for him to come on.
There's a method. Right. There's a method to my madness.
I like it.
But he says a crash would need a supply shock, and it would be very difficult for there to be a supply shock to the market. Again, if we go back to that, there's 2 million new households being formed right now in the US per year. Builders would need to build dramatically more homes than they're building right now.
And that's just impossible for so many reasons. Yeah. Like there's the lumber supply shortage, there's the supply chain and logistics, there's all these, shipping containers out in the Atlantic just sitting there waiting for a place to come in. Like there's just, that's not going to happen anytime soon. So the supply shock, David Stein is saying that basically you need a demand shock and a supply shock. We've already had the demand shock. And if you have the supply shock along with that, then you have a potential for like a crash or a 2008 scenario. But that's simply not feasible unless, something, I shouldn't say that. Is it something completely out of left field happens in, the following 6 months?
If there was a huge spike in interest rates that could
That's a good
cause
point.
something
Yeah.
significant
Yeah. If for
to
some reason
happen
that happened. Yeah.
in the market. It doesn't seem like there's going to be a huge spike in interest rates. I think I'm coming back to this idea of, because housing prices increased so dramatically over the last couple of years, that by appreciation starting to slow, again, it comes back to the psychology. People are going to feel like prices are dropping, and yet they're actually not dropping. It's just they're leveling off, and appreciation is slowing.
Yeah. And that, I think that'll just start to normalize behavior somewhat. But I think I want to go back to the point where you said, let's keep it in the context of our listeners. I would assume most are real estate investors, but also assume that most have at least some part of their portfolio that's long-term buy and hold. I'm sure we have flippers and we have, short-term rental folks and stuff like that. But I think one of the strongest points for long-term buy and hold is exactly what you said, that despite all this madness, it can go up $40,000 in 3 weeks. It can go down $40,000 in 3 weeks. So long-term buy and hold investors, as long as you have tenants, that simply does not matter. The rent is still $1,500 and you're providing a safe and healthy place for them to live. And as long as they pay $1,500 a month, it could go up $1 million tomorrow. It could go down $1 million. It doesn't matter, because you're not selling. They're still living there. They're paying rent. You're building up equity. Your principal's getting paid down. You still get all the tax benefits, et cetera, et cetera, et cetera. And I think you always go back to this when we're talking with our clients. And I think it's a great point that if you're in the markets where you're buying, $100,000 to $200,000 properties, which is the bulk of a lot of long-term buy and hold investors' portfolio, crazy spikes like this don't really affect those values as much. Like if you have a $150,000 house, it's not going to go to 400,000. Like it's just not yet. I'm not going to rule anything out this year, but it might go to 160. It might go to 130, worst case scenario. And again, regardless, doesn't matter, because rent's still being paid. You're not actually gaining or losing value until you sell. So it does not matter. However, if you're in DC and you have a $600,000 house, that thing could go to 700, or it could go to 450. Like that is much more realistic than if you're in the Midwest markets or down south, or some of the markets that we work in, where you're in that range of $100,000 to $200,000. These spikes just don't affect it as much as these higher end properties. And that can be comforting to some people. Some people like the wild swings, especially when they're up. Yep. But when they swing down. But again, even on those properties that are that much money, they can swing up, they can swing down, as long as the tenant is in there and paying rent. It doesn't really affect you until you sell. So I wanted to harp on that, because I think that's super important. And some people that are newer to real estate investing don't get that. Like, what if the house goes down? It doesn't matter. Are you selling? Mm-hmm. Then it doesn't matter. Like it's just keep doing what you're doing. Mm-hmm. So I think that can be comforting.
Yeah. And the other thing that brings me back to is buying for cash flow and being conservative and running your numbers and analyzing the numbers ahead of time. We both recently listened to a Bigger Pockets podcast, and I forget who it was that was talking about it, but the perspective was, well, it's okay if I buy something that doesn't cash flow for the first 5 or 6 years, because I know it will eventually. And that's one approach. However, for investors who are more risk averse, that is not necessarily the approach that they want to take. It's okay to stay conservative and say, I'm going to be patient. I'm going to wait until I do find the deal that I know will cash flow, and maybe not $500 a month, but as long as I know I can cover the mortgage, I can be putting money aside for future expenses, for maintenance, and comfortably have all of that covered, then it just creates some cushion. And John and I often, when we're running our numbers, will think, what if the economy took a downturn and we needed to lower our rent a little bit to keep our tenants in? Because I would rather keep a tenant in place at a little bit lower rental rate than have a property vacant for 6 months or so. And so we even factor that in on the analyzing side of things from the beginning, again, just to run through different scenarios. And that's one way, again, to just kind of hedge against some sort of downturn. And it gives us peace of mind, allows us to sleep better at night when we realize, well, we can. I mean, hopefully we don't have to, but if we had to lower our rents a little bit, we still could cover all of our expenses. And that gives peace of mind.
No, I think that's super smart. And I mean, anyone who's listened knows Lisa and I are all about peace of mind and being able to sleep at night. So I think, and that has happened on at least one property of mine this year. I have had to lower rents just because the rents were, even though prices were skyrocketing on purchasing homes, rentals were going down in major metropolitan areas because of exactly what I said. People wanted out of DC. They wanted to go to the suburbs of Maryland and Virginia and have a yard and have some space to walk around and breathe. So I was not able to charge as much in DC as I had previously for the past 7 years. But it was fine. I'm still cash flowing just fine and everything's good and the tenants are happy. And, when that turns over again, I'm sure at this point I'll be able to charge what I used to, if not a little bit more. So, things fluctuate. And I think being flexible and being able to pivot with the market, especially a market like this, that no one has any idea what's happening. I mean, Lisa and I are throwing out a lot of numbers and a lot of thoughts. And we think we kind of know what we're talking about, but like no one knows for sure. I don't know. What if the Fed says, all right, interest rates are now, 6%? That changes everything. We just don't know what's going to happen. But anyways, yeah. So the point is that you can be flexible and you just kind of have to pivot and adjust your strategy. I don't want to just stick with one strategy and, be stubborn about it. Like if you're like, no, I have to get X amount of dollars per month on this property, then you might have a vacant property for 3 months and then check our blog from like a month ago that we wrote about vacant properties worth lowering the rent a little bit. And you'll see that the numbers on that don't make any sense. So just be flexible. And I think, I don't know, what's our words of wisdom?
The other trait for me, as I'm listening to you talk, Tim, is patience. Be patient.
Yeah, be patient.
So I recently finished reading the book, The Psychology of Money. And
that's a good one.
One of the things, we should have a whole episode talking about that book. It's very good.
We should have him on. How about that?
Oh, that's even better.
Maybe he's listening. Yeah.
One of the things he talks about is know which game you're playing. So one of the things that he brings out in this book is know what game you're playing and don't compare yourselves to other people who are playing another game. And I thought, man, that is so great. And in the real estate investing world, we're always comparing ourselves. We're listening to these podcasts, these, people that have millions of doors and all of this property, and they did it in, 12 weeks. And
right.
You know what? They're playing a different game, and that's great for them. And maybe you want to play that game. So go for it. I'm playing a different game. And so not to compare myself to somebody else because they're playing a different game. Know the game that I'm playing. I set my rules. I set my boundaries for that game. And I need to make sure that I continue to keep my focus on my game that I'm playing. And mine's a long-term game. So that comes back to that patience that I, came to mind as you were talking a few minutes ago. Patience is another trait that I think is really important, along with the flexibility and the adaptability with this. Be patient. I'm playing a long-term game.
Yeah. No, I think that's an awesome point. And I mean, even just apply that to these skyrocketing prices. Know what game you're playing. Like you could see your house go from 400 to 450 and maybe think, I've only had this 3 years, I can sell, and maybe that's a great thing if that's the game you're playing.
Yeah.
But if you're a 30-year long-term buy and hold investor, like, that most likely that's going to go up to 450, back down to 400. And then in 30 years, it's going to be worth 600. So like if your game is to get as much profit immediately as possible, maybe selling does make sense. If you want the most net worth in the long term over 30 years, it probably doesn't make sense. Mm-hmm. So that patience and just kind of like self-reflection and checking your why, as we always say, like, why am I doing this in the first place? Keep doing that continuously and be patient and don't don't panic.
Yeah. One last point I want to bring in from David Stein. He really emphasizes, and I love this. I mean, it's so obvious, and yet him saying it, I'm like, of course, real estate is local. So what's happening in St. Louis is very different than what's happening in Buffalo. And that's very different than what's happening in Atlanta. And that's very different than what's happening in Fresno. And that's, on and on. Real estate is local. We've got to look at local markets, understand patterns. There's a fair amount of moving around right now, right? With COVID and people moving out of the cities and these migration patterns. That's going to influence prices, restrictive zoning, local laws for tenants and landlords. There's so many different things. And it's really easy to talk about the market in general. And yet the United States is huge and so diverse. And so many people come to us and are shocked when they realize they can buy a house for about $100,000 still in 2021. And it's like, yeah, you can. It's very market specific. And that can be a solid rental in a stable working class neighborhood. And it's just going to go and work for you for decades to come. But real estate is local. It's going to be different in every single market. And that's important to keep in mind.
Yeah. No, I think that's a beautiful point by David Stein and a great one to end on. And, we're happy to help folks figure out these markets because they're not in your face all the time. Like these are things that we've researched thoroughly and they continue to change too. But like Lisa said, you can still find deals even today in 2021, mid of the pandemic, like there are always deals. You just need to do a little bit more work.
Yeah. And be patient.
It's a virtue after all, right?
It is a virtue, only for doctors.
Be virtuous. Right.
Did you ever hear that joke?
No, I don't get it.
Patience is virtue for doctors. Patience.
Oh,
doctors.
Oh my God. That was like a grandpa joke. I like it. It's a spelling joke, right, guys?
Not even a dad joke. That's a grandpa joke.
No, that just skip dad jokes altogether. Lisa's secretly a grandpa.
I have been told I'm an old soul, so I'll take it. Tim, anything else you want to add? Anything else you want to share before we wrap it up for today?
No, I think patience is it. I mean, I think you nailed it. I don't like all this doom and gloom and chaos and hyper. Just calm down. Let's everyone relax. It's been a crazy 18 months for millions of reasons. Let's keep the big picture in mind. It's an insane market. Do your research, talk to people that know, think about it twice. Always sleep on it. People get all caught up and they're like, oh my God, it's crashing. I have to buy all that. No, just chill out. Just take a breath, sleep on it. It's going to look different tomorrow. If it still looks the same, then maybe make a move, but just take your time. And don't panic. That's final thoughts. Don't panic, be patient.
Yeah. And I would just say, if you are listening and you're a new investor, you have not missed out on all the deals. There are plenty of properties out there that will work for you. And if you are interested in learning more about that, feel free to get in touch with us and we'd be happy to chat with you about it.
For sure.
All right. Well, it has been great to chat with you, Tim. And again, these are unofficial notes from us. We are not economists. We are not prophets. We are not financial advisors.
Dear God, no. None of the above. Disclaimers.
If I get anything right in my prophesying, I hope that it's Robinson number 4 is arrived in the world by the time our podcast is released.
Me too. So. If not, we're in big trouble. By the time this one comes out, if he's not here, we're in big trouble.
It's going to be overbaked.
Yeah.
All right. Well, we will look forward to having you join us next time. We've got some great guests who are lined up and lots more to share with you before we wrap up season 2 in a couple months. So thanks for joining us. Please feel free to share it with a friend. We are really grateful if you take time to leave us a review. And until next time,
happy real estate adventures.